All right, so today I wanted to make a video on the top Canadian dividend or covered call or slash covered call ETFs. Five of these I've never made a specific video on, and I've barely talked about them. So I wanted to dig a little bit deeper. There is seven in total, so I'm not going to go too crazy into detail. Frankly, you don't have to. Um, First things first, if you get value out of the video, please like and subscribe. Check out the links below as always. So let's get right into it here. The first three are from Hamilton. Obviously, they are the same fund company that has HDIV and SMAX, which I'll briefly bring up at the end. So the new one, these are new ones that they just came out with. They debuted in July, so these have only been around for a couple months or so. So the first thing I would bring up with these is that it's hard to draw definitive conclusions on these. It's very, very hard because the thing with covered call ETFs or like high dividend ETFs is when times are good, when the underlying index or the underlying stock is doing good, they almost always do good. The big question with a lot of these is when the stock is down or when the index is down, do they underperform? And do they make up the price returns when the index or the shares recover? That's the big question with a lot of these. These ones, obviously, they've only been around for a couple months, so it's very hard to draw conclusions. There's no way of knowing that. But the one thing that makes me confident in them is, like I mentioned at the start there, this is the same fund manager that operates HDIV and operates SMAX, which I both like. Both of those have not only positive share price returns since inception, but like they've been around for like 3, 4 years respectively, and they're up like 25% each, which for a covered call fund that pays a double digit dividend, that's phenomenal, right? That is absolutely phenomenal. So that's what gives me confidence in these. There's two main differences with these. The first one is they use a little bit of leverage. They say 25%. Now again, that's not always going to be exact, right? Whenever you're using leverage, you have a levered fund or whatever, it's never going to be exact, right? It never is. It'll be exact over like a day or a week typically, but not for extended periods of time. But when it comes to these, the other thing is they pay dividends twice per month. Rather than paying monthly, they pay twice per month. I would prefer weekly, but again, twice per month, I'll take it. The other thing, and the biggest, I think the biggest opportunity or the best thing about these is their current dividend yields are around like 19 to 20%, right? 19 to 20%, give or take. And there's three different ones. There's C day, there's S day, and there's Q day. The difference being is C day has a 25% stake in the S&P 500 and then a 100% stake in a Canadian index. S day has a 25% stake in the S&P and then a 100% stake in the US index. And then Q Day is a 25% stake in the NASDAQ or the QQQs and a 100% stake in a US index. So they're all a little bit different, but they're all kind of the same. The one that's performed the best is C Day, but again, we only have about 2 months of data to go off. If we look at their prospectuses here, again, it goes over their net asset value. So again, they use zero DTE options to generate their yield, which means they're selling options every single day. That's how they're generating the income essentially. Again, they pay twice per month, 25% leverage. And not only that, another thing that's interesting here as well is that they maintain exposure overnight to capture potential gains they see. I'm not honestly not sure if that actually makes a whole lot of difference, but at least they say it. If you look at their management fee, 85 basis points for an actively managed fund of this scale, that's not bad. I mean, a lot of people would see that and say that it's high, but I don't think it is. So I really do like the twice per month payments. Yeah, obviously weekly is better than that, but it's still nice, right? The more often they can pay, the better. The assets under management for these still aren't that big, but I think they're going to grow, right? I really think they're going to grow. Hamilton is one of the biggest, if not the biggest, at least of the ones that have covered call funds in Canada. So I think these are going to grow. I really hope they continue to grow because these have a lot of potential, I think. But again, it is so early. So that is the first three of these funds. The next ones I wanted to talk about are from Harvest. Now, this is HBTE and HBIX. Now, the difference between these two is they pay monthly, so you're not getting weekly or twice per month payments. The good thing about these ones are Bitcoin funds. HBTE is a little bit different. HBIX, so let's get into HBT first because this is the one that I have this is the one that I have pulled up. So again, covered call fund, they also use a little bit of leverage, about 25%. If you look at its current dividend, it's around 20%, almost the same as the other three I just talked to. Again, this will vary day to day. Keep that in mind. These ones have been around since I believe about April. They're about the same as far as funds, assets under management. I hope these continue to grow as well because I think these have a ton of potential as well. If we look at the management fees, actually less, it's 75 basis points, which obviously I like that. If we look at let's look at its portfolio. If we look at its portfolio here, so this one holds essentially it holds Bitcoin companies, Bitcoin treasury slash miners, right? So they have IRIN, they have Block, they have Coinbase, they have MSTR, they have Mara, they have Riot, Galaxy, Core Scientific, TeraWolf, and then they have IBIT. I wish MSTR was their biggest position. I really don't know why it isn't. I don't know how, honestly, I don't know how they determine their allocation. You could probably read it up if you read up their whole brochure, but that probably is quite uh, big, and I wouldn't want to do that at least yet. So um, this one is a little bit different in that if you look at HBTE, it basically sells calls on companies adjacent to Bitcoin. HBIX is different in that HBIX is just I believe it's just IBIT. Let's double check that. Yes, it is just IBIT. So that is the difference here is the dividend is about the same. This one's slightly larger. The management expense ratio, I believe, is the same as well. Actually, it's lower, 65 basis points. This one, technically, it's just using one index, so that would make sense that they charge a little bit less. So that is a benefit to this one, but again, at the end, it's not that much of a difference. So this one hasn't performed as good, but I still think it's worth owning because at the end of the day, like I always say, the Bitcoin miners, the treasury companies, they need Bitcoin, but Bitcoin doesn't necessarily need them. So the last two are HDIV and SMAX. I've talked about these quite a bit before, so I'm not going to go into big details on them. Like if you look at HDIV here, HDIV since inception with dividends is up about 71%. The S&P is up 56%. So this is a fund that pays a 10 points, at least at the time I'm making this video, 10.66% dividend yield, and it's outperforming the S&P, and that the actual compounded annual growth rate to the dividend is also going up, which is also phenomenal to see. So I really like this fund. Obviously, it doesn't pay a crazy high dividend by any means, but it's growing its dividend and it's performed extremely well. So this is a must own in my opinion. Max is not quite as good, and I'll show you why. S-Max hasn't performed quite as good. If you look at it, it has slightly underperformed the S&P since inception, up about 50% versus S&P up 60%, 50 versus 60. Although you look at its price returns, the price returns are plus 23%. Like I said, for a covered call fund, that is very, very good. This is a very important thing. Also, dividend yield almost exactly the same. And if we look at its dividend over time, it has gone up actually quite nicely. So that's another nice thing to see. Just out of curiosity, how much has HDIV's share price grown since inception? Not as much, about 13.5%, but again, the dividend is actually better, so that's caused it to outperform. So let's check out the other ones, just some curiosity here, just for performance. Like I mentioned with C Day, S Day, and Q Day, they've only been around for a couple months, so I wouldn't draw a lot of conclusions based on the share price returns, just because 2 months is not, it's not a good enough sample size. So if we look at their uh, returns. C day is up 6.37 versus 4.58 for the S&P. If you look at Q day, Q day is up 3.88 versus 4.58. And then if we look at S day, 4.17 versus 4.58. So nothing, no clear conclusions can be drawn. I would wait till the end of the year to draw conclusions at least. Honestly, I'd like to see like a 10-20% pullback in the stock market before I drew conclusions. And then I would know for sure. If these funds can outperform the S&P over the next 6 months, over the next year, I will start to like them even more. And then let's look at the other two, and then we'll close it off here. So if you look at HBIX, this is the one that just has the IBIT as the index that holds. So again, it's up 21% with dividends as opposed to 17.69 for the S&P. So there's two reasons that I really like these funds. You're not getting a crazy high dividend like you are with XBTY or even MSTY, but you are getting, look since they came out back in April, 15% price returns, right? So you have that positive price return. Also, you've outperformed the S&P. So that's something, and even just price returns, right? The S&P price returns is up 17% versus 15%, right? So it's almost the exact same. Almost the exact same. So that's something that I really, really like to see. And then if we, the last one here, let's close it out on HBTE. This one's actually outperformed by quite a bit compared to the other one. So this one, again, they came in at the exact same time, so that's why it's a good comparison between the two. This one's up 61% and even 51% just based on the price return. So this one has easily outperformed HBIX. But the one caveat that I think is important to throw in there is this one holds the miners and the treasury companies. So if Bitcoin goes down, this one almost certainly will underperform. Now, again, when Bitcoin is up, like it has been over the last, whatever, 4 or 5 months, this one will outperform. So if your only goal is to outperform this one, if you were to hold just one, yeah, I would choose this one. But you also have to keep in mind that straight Bitcoin is safer than the miners and the treasury companies. So even though this one's clearly outperformed, I still hold roughly the same amount between the two. But again, if I were to choose just one, it's going to be this one because it has more upside. The dividend is about the same, right? The dividend's about the same, so that's nothing to write home about. It's just this one is going to outperform if your only goal is, or if you're to only buy just one. So that is my breakdown on the top Canadian dividend funds. The last thing I would leave it on here is for all the Canadians out there, the one mistake, not the one mistake, but one mistake that I think that Canadian investors make is that they're overexposed to the Canadian markets. I know two people personally that they didn't show me their whole portfolio, but they told me pretty much what they own. And both of them just owned Canadian ETFs, like just Canadian ETFs. And I think that is a huge mistake because it really makes no sense. Number one, because the Canadian dollar, does anyone like being perfectly honest here, do you have more confidence in the US dollar or the Canadian dollar over the long run? Now, I don't have confidence in either of them compared to Bitcoin, compared to like a gold, but it's going to be the US dollar. So people say, oh, I can save, I don't have to pay that dividend withholding tax, but it's also like the Canadian dollar's been absolutely destroyed over the last 10 years. And I don't think anything is going to change until big things change in Canada. And I don't know if that's going to happen soon. So that's the mistake that I think Canadian investors make. Not that I would just say blindly buy American or blindly don't buy Canadian, but I am saying I would never, ever, 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 maybe not, maybe that's a little bit of an overstatement, but I would be very hesitant to not buy a fund simply because it's American or buy it's the whole, the Canadian S&P index versus the US S&P index. I would buy the US one for sure, right? For sure, because I can trade options on the American index. I can't do that on the Canadian ones, right? And you can make an extra 2, 3, 4% per year if you trade options on the indexes. You can't do that with the Canadian ones. An extra 2, 3% per year over 30 or 40 years is an insane amount of money, right? An insane amount of money. And it's way more than you're going to save by not having to pay the dividend withholding tax. So that's the last thing I wanted to leave it on here. So like I said at the start of the video, if you got value, please like, subscribe, comment, check out those links below, and stay tuned for more.